What if I told you that the housing market right now is flashing the exact same warning signs it flashed right before the great financial crisis? Back then, home prices crashed by 40%. The economy plunged into the worst recession most of us had ever seen. Millions of people lost their homes, their jobs, and their savings, and right now the signals lining up in the housing market are eerily similar to what we saw in the years leading up to that collapse. Here's why that matters to you, even if you're not buying or selling a home. When housing slows down, it doesn't stay contained. It spills over. Job losses start mounting. Delinquencies surge across credit cards, auto loans, and mortgages. The credit bubble starts to crack. And when that happens, stocks follow. Your investments, your retirement accounts, everything connected to the broader economy gets pulled into the downturn. We are walking down the same path right now, and if you're not paying attention, it could blindside you. So today I'm going to break down exactly what's happening in the housing market and why it's deteriorating so fast. I'll show you how the problems in housing spill over into the broader economy. We'll look at what builders are doing that's actually accelerating the collapse. And then I'll walk you through specific strategies you can use right now to protect yourself and even profit from what's coming. Let's get into it. Let's start with the clearest warning sign, and that's the surge in unsold inventory. Right now, home builders are sitting on the highest number of unsold completed homes since 2009. Think about that for a second. The last time builders had this many finished homes that nobody was buying, we were in the middle of the worst housing crisis in modern history. And the problem is especially severe in states like Florida and Texas, where resale supply is also flooding the market at the same time. To put this in perspective, unsold completed inventory bottomed out at around 32,000 units back in January of 2022. That was the peak of the frenzy, when everything was selling the moment it hit the market. Fast forward to today, and that number has exploded past 115,000, and it's still climbing. The trajectory looks almost identical to what we saw in the years leading into the great financial crisis. And here's what's important. The catalyst driving this is the same one that drove it last time. Average hourly earnings for production workers, the people who actually make up the bulk of the economy, have stagnated or declined in real terms when you account for inflation. It doesn't matter that the stock market has been hitting highs. The people who need to buy homes can't afford them. That disconnect between asset prices and real wages is exactly what we saw before the last crash. Now, here's something that most people don't realize, and it's critical for understanding why this matters beyond just housing. Housing leads the economy. It always has. When you look at the data historically, housing starts begin to turn down first. That's the blue line on the chart. Then the stock market follows. That's the red line. And after that, the broader economy and the labor market roll over. This sequence has played out before every major economic downturn. Housing doesn't crash because of a recession. Housing crashing is what causes the recession. And right now, we're in the early stages of that familiar pattern. The good news is that if you understand this relationship early, you can position yourself ahead of it. You can protect your portfolio and even find opportunities to profit while everyone else is caught off guard. So why is inventory piling up so fast? Because buyers are disappearing. The latest data from Redfin paints a stark picture. Nationally, the number of active buyers is collapsing while the number of sellers is rising. That combination, fewer buyers and more sellers, has historically only shown up right before significant price drops. And when prices start falling, it creates a feedback loop. More inventory sits unsold, which pushes prices down further, which makes even more buyers pull back, and the cycle accelerates. This isn't just hitting the entry-level market either. The high end is feeling it too. Toll Brothers, one of the biggest luxury home builders in the country, recently missed their order estimates. They blamed it on high prices and economic uncertainty. But let's call it what it really is. It's an affordability crisis. Even buyers in the upper income brackets are looking at these prices and walking away. And here's a data point that tells you everything about the state of the American consumer right now. A record 331,000 men in this country are working 2 full-time jobs simultaneously. When you include women, that number jumps to 476,000. The total number of people holding multiple jobs has hit 8.77 million, which is near an all-time record. People aren't working 2 jobs because they want to. They're doing it because one job doesn't cover the bills anymore. These are not people who are about to go out and buy a home. Meanwhile, Builders are doing the opposite of what you'd expect. Instead of pulling back, they're actually increasing production. Housing starts rose 6.2% in December to an annualized pace of 1.4 million. They keep building, but they can't sell what they've already built fast enough. The inventory just keeps growing, and it's about to get worse. While housing starts have now declined for the fourth straight year, building permits actually rose 4.3% to an annualized rate of 1.45 million. That's the highest level since March. Permits are a forward-looking indicator. They tell you what's coming down the pipeline, and what's coming is even more supply hitting a market that already can't absorb what's there. This is setting up a serious inventory overhang that's going to put intense downward pressure on prices in the months ahead. Now let's talk about the credit side of this, because this is where things get really concerning. Delinquencies are rising across the board, and they're rising fast. 12.7% of credit card balances are now 90 or more days delinquent. That's the highest level since 2011. Auto loan delinquencies at the 90-plus day mark have hit 5.2%, the highest since 2010. People are falling behind on their basic obligations at a pace we haven't seen in over a decade. Why does this matter for housing? Because when you overlay rising delinquencies against housing activity, the pattern is crystal clear. As credit card delinquencies go up, housing starts and home sales go down. Every single time. It's not a coincidence. When consumers are stretched to the breaking point on their existing debt, they're not taking on a mortgage. They can't qualify even if they wanted to. And younger buyers are getting hit the hardest. Student loan delinquencies at the 30-plus day mark hit a record 16.4% in the fourth quarter. At the 90-plus day level, we're at 16.2%, which actually exceeds the peak we saw back in 2013. These delinquencies don't just go away. They damage credit scores for years. They lock an entire generation out of home ownership during what should be their prime buying years. It's no surprise that the average age of a first-time homebuyer has now climbed to 40 years old. And it's not just residential. Commercial real estate is flashing its own warning. Office property delinquencies in the commercial mortgage-backed securities market have hit 12.3%, an all-time high that exceeds even the peak after the great financial crisis. When commercial real estate is in this kind of distress, it signals that the office market isn't recovering, which means the job recovery that would support housing demand simply isn't materializing. Let me put the affordability crisis in the simplest terms possible, because this is really the heart of the problem. Back in 2005, right before the last housing bubble burst, the median salary in this country was around $46,000, and the median home price was about $184,000. Today, the median salary has risen to roughly $59,000. That's an increase of about 28% over 2 decades. But the median home price has jumped to around $450,000. That's an increase of 150%. Wages went up 28%. Home prices went up 150%. The math simply does not work. You cannot sustain a housing market where prices have grown more than 5 times faster than the incomes of the people who need to buy those homes. Something has to give, and historically, what gives is prices. Now let's look at the broader economic picture, because there's a troubling dynamic developing that most people aren't talking about. GDP grew 2.7% last year. On the surface, that looks solid. But here's the problem. Employment barely grew at all during that same period. We're seeing economic output expand without meaningful job creation. That's what economists call a jobless recovery, and we've seen it before. It happened in the early 2000s after the tech bubble burst. What makes this particularly dangerous is that this would be the first recovery cycle in recent memory where the economy grew without adding jobs in a meaningful way. That creates enormous uncertainty for builders, for consumers, for the entire economic ecosystem. If people aren't getting hired, they're not buying homes. If they're not buying homes, that inventory keeps piling up. And if that inventory keeps piling up, prices fall, construction slows, and the ripple effects spread through the entire economy. Michael Pierce, an economist at Oxford Economics, put it really well. He pointed out that the conditions aligning right now mirror what we saw in the early 2000s. Companies overhired during the recovery, productivity gains, and technological advances are reducing the need for workers, and policy uncertainty is making businesses cautious. The labor market is essentially the last firewall protecting us from recession. If that breaks, housing goes down and stocks follow right behind. Let me give you a quick update on what the charts are showing us right now, because the technical picture is confirming everything the fundamental data is telling us. The NASDAQ 100 has been showing what's called a WAF distribution pattern. Recently, we got a rebound up to the 100-day moving average, the blue line, which also converges with the 50-day moving average in green and the 21-day in red. This is a critical area to watch. If the index gets rejected at these levels and breaks below the lower purple support line, that would signal an imminent correction. The charts are essentially coiled, waiting for a catalyst, and the deteriorating housing and labor data could easily be that catalyst. So with all of this in mind, let's talk about what you can actually do to protect yourself and position for what's coming. The unsold inventory trajectory is tracking the great financial crisis path. The jobless recovery is putting stress on every part of the economy. If the labor market breaks, the game is over for this economic cycle. And the stock market, particularly the NASDAQ, is on the cusp of a significant move lower based on the technical setup. The first thing you need to do is act now, not later. Start diversifying away from technology stocks, cyclicals, and consumer discretionary names. These are the sectors that get hit hardest when the economy rolls over. Instead, rotate into defensive sectors like utilities, healthcare, and consumer staples. These are the areas that hold up when everything else is falling apart. Now, gold and silver. I know a lot of people are excited about precious metals right now, but the charts on both are actually showing poor technical setups at this point. That doesn't mean they won't eventually be a great trade, but right now, the smart move is to follow your system and use stops. Don't let emotion drive those positions. For more experienced investors, there's an opportunity to tactically short big tech names. Corporate insiders have been selling at an elevated pace. The NASDAQ can't hold its 100-day moving average, and the WAF distribution pattern is nearing its end stage. These are the kinds of setups that precede meaningful declines, and regardless of your experience level, you should be holding at least 20% of your portfolio in cash or short-term treasuries. Jeffrey Gundlach has been recommending this approach, and I think it's exactly right for this environment. Cash gives you the flexibility to act when opportunities emerge after the decline, and keep a close eye on the long bond, because there are signs of a breakout forming amid the weakness in the dollar, yields, and the labor market. Speaking of systems, let me show you what our CTA Timer Pro subscribers have been seeing. In just the last 5 days, subscribers captured a 4.55% gain on a utilities swing trade. The system has a 1.78 profit factor, which means for every dollar risked, it's returning $1.78. Here's how the system works. It optimizes machine positioning thresholds that are back-tested against 10-day forward returns. The goal is to maximize win rate and returns while keeping drawdowns as low as possible. On a daily basis, you log in, check the reports, see the trade recommendations for both long and short positions, review the risk levels, track your open trades, and get weekly updates that keep you informed on what's happening and what to expect. If you want to try it for yourself, there's a 30-day free trial available right now. Just check the links in the description below this video to get started. That's everything I've got for you today. If you found this valuable, make sure to like the video and subscribe if you haven't already. I appreciate every one of you for watching. This is Steve Van Meter, and I'll see you in the next one.